Can government employees take full control of their income when they retire or resign? Now, earlier this week, Grace reached out to me for help. She had resigned less than a year ago and she wanted access to some of her capital. I mean, it is her money, right? So she should be able to access this and do anything that she wants, right? Anything that she pleases. But here's where things get a bit tricky. Her income changes could only be made once in a year. Hi, I'm Dhevan Naicker, your Retire vs. Resign specialist, and I help government employees like yourself navigate the critical decisions around retirement and resignation and financial planning. In today's video, I'll be sharing with you 5 income for life options that are available on resignation and how they affect your ability to control your income. I'm also going to be sharing with you strategies to ensure that you take control of your income and avoid these common pitfalls. Now, before we dive in, please make sure that you hit the subscribe button so that you do not miss out on future insights and videos that we get created. Let's get started. So when it comes to retiring or resigning, naturally, if you are aiming at retiring, you are in a position where you would receive an income as well as a lump sum gratuity, right? On the resignation side, I've covered this in previous videos. Once the funds gets transferred over onto your approved fund, so let me just draw it for you here. Pardon me, I can do that circle a lot better. So once your money gets moved into the approved fund, you then have the option to access a portion of that in cash. This is where you would have heard me saying previously, you can access 1/3 in cash, and the balance, which is the 2/3, is what must be invested to provide you with an income. Now, there are 5 income for life options that are available. I'm going to be going through them in a bit more detail, and I'm also going to be explaining to you where the element of control lies, right? Because usually for most of these options that I'm sharing with you, once you make that decision, it cannot be reversed, which means it's critically important for you in the beginning to be crystal clear that it's the right option for you. So let's go with the first option, which is an income for life. In essence, the insurance company takes away your capital, right? So I'm going to say here, take your capital, meaning it's no longer your capital, it now belongs to them, right? There's a trade, right? There's a trade. So in return for the capital, they are going to be giving you an income. Now, in the beginning, when this income is getting set up, there is a degree of flexibility. And flexibility in terms of you being able to choose, hey, what the annual increases are. So you can adjust that right in the beginning. Right? So they offer you some element of flexibility, you agree? And that becomes a nice plus factor. The problem or the concern around this one, especially if you have a spouse or you have got family, kids, that you want to inherit your legacy, that lump sum, this option cannot do it because the income is only provided for your life, no one else's. So touch wood, you close your eyes, that's it. The income itself is going to stop, and the capital, remember the moment that you went into this plan, the insurance company took it away, so it was never yours. So they keep whatever's left over, right? So whatever's the balance stays with them. This is option 1. Now the next option, option 2, in this option, it's like option 1 because you're able to now earn an income. But in addition to that, there are 2 sets of income. So let's go. So the capital again is taken, right? So you're giving that capital away. In return, you are now receiving an income, and that income is going to be provided for you plus your spouse. Now, you do have an element of control here. So let's start to have a look at some of the benefits, right? You can adjust the annual increase. So you can choose how much the increase in the income would be, right? Keep in mind, though, if you want a high increase in your income every year, then your initial income will become very low. Right? So let me go back here to illustrate that point. If you are going to say to them, hey, listen, I want my annual increase to be high, right? A high annual increase, then in the very beginning, your income is going to be low. And the opposite is true. If you're going to say you want low annual increases, then in the beginning, your income is high. So the same carries on with this option. You still have the option to adjust that income on an annual basis, but obviously it's set in the beginning. So once it's set in the beginning, it cannot be changed later on. It becomes cast in stone, right? So you get the option to choose it in the beginning, and that's it thereafter. You have to stay with it. Now, in addition to that, you can also choose exactly how much income that your spouse would receive. Meaning, you could choose 50%, you could choose 75%, 100% even, right? Meaning, touch wood, you close your eyes, your spouse then gets the same income that you were getting, right? If it's 100%. Again, the same concept as what I shared with you earlier. If you are going to be taking a high income, so if you want your spouse to get a high income if you close your eyes, then it means your initial income will be low, right? It's a give and take. So think of this like as a seesaw, right? Then let's look at option 3. Now with option 3, you have the same like what I shared with you just now on option 1 or 2, except there is now a safety net. So keep in mind, your capital again is taken, right? Here. And depending on the option that you take, you are now receiving an income that's for you and or your spouse, okay? Depending again on which option that you've chosen. Now from this perspective, next up, you then can elect the length of time that they can pay this to you. And it can be up to 25 years, right? This is what is called a guarantee. So 1 to 25. Let me explain how it works. The insurance company is in essence saying to you, hey, listen, I'm giving you a guarantee that come what may, I will pay you for the next 25 years. Now it's up to 25 years, not necessary that you may take 25. Again, remember, the longer your guarantee, the lower your initial income, right? Remember the seesaw we spoke about earlier. So here, let's assume at year X, touch wood, you close your eyes. And at year Y, touch wood, your spouse closes their eyes. Now, can you see from Y to 25, there's some remaining time, right? That income should have been paid, but it wasn't paid. And this is where income can still be paid, and it's where you can then benefit to your kids, right? But once that 25 years are over, both you and your spouse, that's income stops. Income stops, right? That's the third one. Let's look at the next one. This is the fourth one that we are working with. So here, the insurance company again is going to take away the capital. This time they're going to be providing you with an income. And that income is only payable to you. In addition to that, they're also going to give you a policy, right? And that policy is a life cover policy. I'm using an example here and then it'll make a lot more sense. So let's assume here, we're referring to your 2/3 capital, right? So let's assume that you have 2 million rand here. 2 million rand inside. In essence, you're giving that 2 million to the insurance company or the investment house. In return, they start paying you with an income. Now, they will also take out for you a life cover. And the life cover will be the same value, 2 million. Which means, touch wood, anything happens to you, the insurance company is going to pay you out, but they're not going to pay you out your capital, you agree? They are going to be paying you out the life cover. So let's recap that. The insurance company takes away your capital. In return, they pay you an income, and they also are going to give you a life cover policy. Now, please keep in mind that you have to pay the premium for that life cover policy, right? So you got to pay the premium for that life cover policy, and you also have to factor tax. Now, usually this type of option, the income is fixed, meaning it does not increase every year. It's a fixed option. So I'm going into a bit more detail in today's video because I want you to understand these options very carefully. Remember, as I said earlier, these 4 options, once you go into them, they cannot be changed, right? It's permanent, cast in stone. Let's look at the 5th option. Now, if you watch the Retire vs. Resign Masterclass, this is the option that most members lean towards because it's the one that offers you the most amount of control. Now, where I shared with you in previous 4 options that the insurance company takes away the capital, here, you are the one that keeps the capital. Now, in the previous options, remember, it's the insurance company that's going to be investing that capital, or assuming that you are aiming at retiring, then the pension fund keeps the capital, right? But in this option, 5th option, that capital stays with you, meaning it's your money. Now, you naturally would take this into the approved fund like I've discussed with you in previous videos, but you are now actually doing the investing here. So when you are doing the investing, that gives you a bit more area of control. So let's take a closer look. There's your capital here. You can then elect to take an income, and this income works on a sliding scale of 2.5% to 17.5%. Now, here's a very important feature for this particular option. You can change this income yearly. So unlike the previous 4 options I showed you, this particular option, you're in control. You can change it every year. Meaning in the beginning, if you started off with 10%, that's your income. At the end of year 1, you can decide whether you want to increase it, decrease it, or keep it the same. But you're in control. All good so far? Okay. And in terms of the year, it's your anniversary year. So let's say you started your investment in June, then June becomes your anniversary month, right? So you earn your income, and then next year in June is where you decide what income is going to happen for the next 12 months, right? Doesn't work with the 12 calendar month or the tax year. It works according to when your investment started. So that's the next part here in terms of your capital. Now, what's the benefit of this particular option is, touch wood, anything happens to you, this is where you can get your kids and your family to inherit. Now, there is a degree of control here, because when you are receiving the income, you're choosing it from the sliding scale, and you can choose the frequency of that income. Meaning, you can elect whether you want that income, to be paid monthly. This is a bit more advanced, okay? But again, this needs to be dealt with properly on a one-on-one consultation. I'll explain to you and also help you to determine which is the right route for you. Quarterly, biannually, which means twice in a year, or annually. So you can elect that. So let's quickly go through an example, right? Say you initially wanted to take an income of 10,000 Rand a month. Then you start receiving 10,000 Rand a month, it will be taxed, right? And then the balance comes in. Say you wanted to receive the income annually, then instead of paying you 10,000 Rand a month, they would now pay you 120,000 right in the beginning, right? In the beginning, month 1. No more incomes for the rest of that year until the next anniversary comes where they pay you the balance, right? And then quarterly, it would be adjusted accordingly. Biannually, it's adjusted accordingly, right? It's like a 2-month, you're receiving 2 incomes in a year. Now, you want to get very close attention to this, again, because you want to have a look at discipline and multiple other factors, right? Including tax and when this is happening, and inside of a tax year, when you received your previous one. So countless factors to keep in mind. But I hope the video has been helpful for you. We now covered 5 different income for life options. I hope you understand a lot more clearly. Comment below, because I did discuss this in previous videos. Let me know if this has been more helpful for you now. If there are any other questions that you have, please post them in the comments below. I'm happy to address them. Remember to click the thumbs up sign if you found the video helpful, because then I know, hey, this content has been helpful to you, and I'll see you in the next video.